Hey, it's Mike. I'm not an investing guru. I'm an average guy sharing my investment journey on the internet. In today's video, we're going to talk about why I'm buying SCHD and SCHY. I have a $320,000 portfolio. In today's video, we're going to be focusing here on the Roth IRA. Side note, I believe that investing in dividend paying companies in your Roth IRA is a powerful way to compound it without being taxed and to allow higher gains. This is my passive income account. In my Roth IRA, I have $35,000. I own two holdings. I own SCHD and SCHY. But you can see over time, my income has been doing fantastic, or my performance has been doing fantastic. The reason this is increasing year over year is because I dollar cost average. Every single week, I put in $125 into this account. So if you look at my activity, you can see every single week $125 in this account until it maxes out at the $6,500 max for a Roth IRA. Now, I just recently switched all my individual stock holdings to ETFs. The reason being is I want to have clarity of mind. I don't want to be focusing on constantly picking individual stocks, and having 80% US and 20% international exposure fulfills every need I need where I don't have to think about it. The reason why I switched to SCHD and SCHY is, one, it's a great ETF. It has high dividend growth rates, it has a high dividend yield, and its performance has by far beaten all the other ETFs out there. Even the dividend growth ones, the high dividend yield ones, it has beaten all of them. And I just want to show you the power of compounding here. So before we start talking about where I'm getting my numbers from, so this is the dividend growth rate of SCHD. So just want to show you SCHD dividend growth rate. So the compound annual growth rate, 13%, 12%, 14, 15, 13, so on and so forth. If I punch that into a calculator, if I punch 13% in a dividend growth rate calculator, so let's just talk about this. So currently right now, $35,000, 4 distributions a year. I'm reinvesting the drip, $6,500 annually, no tax rate because it's in a Roth. The annual yield right now is anywhere between 3 and 3.3. I'm just going to use 3%. This growth rate, about 7% of the return has been from appreciation. And then I'm 30 years old. By the time I get to retire, they'll allow me to retire at 67, so 37 more years. If I calculate this, we're going to have a crazy total return. And the power of compound investing, as well as the dividend growth. The dividend growth is the most important factor that a lot of people miss when dividend investing. They try focusing too much on yield, but if you focus on dividend growth, that's actually one of the most important portions, where if this dividend is increasing 10, 13% every single year, you'll see that when you start getting down into the weeds here, you potentially could be making an insane amount of income if you're being super smart, and that dividend is growing year over year. By the time I'm 67, if I'm making $4 million a year, $5 million a year in dividend income, that's nuts. Now, let's be a little bit more realistic. Like, the last 10 years is not the best indicator of what's going to go forward. So if we use a very conservative dividend growth rate of about 7%, we're still going to be millionaires at the end of this, and we're going to have a pretty decent income. So, obviously the first couple of 10 years, you're not going to have that much dividend income, but once you start getting closer to that retirement phase, you're going to be having $92,000 a year in dividend income. That is a lot. Your yield on cost is 34%, and then you'll have $3 million. So if you have a Roth IRA and you have a 401k that you're, meeting your company's match, if you're maxing it, bonus points to you, you're going to have a very healthy and great retirement. And then on top of that, if you add anything else into your brokerage account, it's going to be great. So this right here is the power of compound interest, that dividend growing. And even if the growth rate isn't that high in the next, 10, 20 years, because that's what the experts are saying, you're still going to be retiring as a millionaire. And actually, you'd make more income because the growth rate is high, and you could buy more shares when it reinvests back in. So that's why I'm investing in SCHD and SCHY. The growth rates are amazing. The performance is great. And I just wanted to simplify my portfolio. So if you look in the last year, we're up over 15%. And if I go to my spreadsheet here, I've done some calculations. So my total cumulative return, because I think the M1 Finance is not the most accurate one. the most accurate one here is in the spreadsheet where I have a cumulative return. So I've been investing in that Roth IRA for about 4.5 years. I just rounded up to 5 years just to make the math super simple. So my cumulative return with dividends is 35.9%, which comes out to a 7% return every single year, which is pretty decent. Okay. Of that percentage, 26% of the return from this total return has been dividends, 26%. If I didn't invest in dividend companies and just focus on the price performance, my cumulative return without dividends would have been 26.5%, which would have put us at 5% a year. You can get bond yields higher than this. Now, the part where it starts getting interesting is if I hold this fund, or SCHD, SCHY, if I hold that fund for 10, 20, 30 years, this dividend yield is going to be very high. So these are the different yields I've been getting per year. And again, I'm like a squirrel when it comes to investing in stocks. Sometimes I get in and get out too many times. And that's why I wanted to focus just on having an ETFs in here. So I made a little rules-based approach for my Roth IRA. My number one thing is you want to make contributions to your Roth. That's a given. Weekly deposits. So every single week, I'm putting $125, which is the max for the full year, which would put you at $6,500. I wanted to have a dollar cost averaging approach. Could I have just thrown $6,500 in there? Yes, but I think just dollar cost averaging, setting and forgetting is a very powerful tool to do. Now, dividend income, dividend growth. So I wanted, when I picked this, I want to get dividends. If you look throughout history, and just like even what I have shown on my spreadsheet over here, is most of my return, like a good portion of returns have been from dividends. And if you're discrediting dividends, you're losing a portion of that company's, your total return. So I want to have a decent amount of income. I think if you can have an average yield for a company at 3%, you're winning. 3%, and then that dividend grows over time. That's a winning formula. So eventually in my brokerage accounts, once I'm done buying a bunch of income investing style strategies, I'm going to start picking individual stocks where I can be getting 3% return with dividends. And then the dividend growth, I don't really care about the initial dividend yield. I would like it to be higher, but if it is a smaller yield, I don't care much about the smaller yield. I just care about how fast they're growing that dividend. And one of the best things you can tell if a company's going to grow their dividend fast is if they're increasing their free cash flow. If they increase their free cash flow, they'll have more money to pay out in dividends. Then, continuing my rules-based approach in my Roth IRA, I want to invest in ETFs and I want to set and forget. Just like I mentioned earlier, I don't want to be spending so much time picking individual stocks. I'm going to do that in my main brokerage account. My 401k and my Roth, I just want to set and forget, and I don't want to think about it. My brokerage account, I could play around a little bit more. The goal here is to reduce turnover. I told you, I'm a squirrel when it comes to investing. I try picking, choosing so many different things that I just need to stop doing that and let the money compound and let the experts pick whatever stocks in the fund, and that's it. And then my last rule here is I want 80% United States, 20% international. So that's kind of like my rules-based approach to investing. And I just thought that some of these numbers would be very interesting to see with dividends versus without dividends. So every week, $125 in here. You can see that over time, it's been going up and up. Even through the Corona crash, you can tell it crashed here, but then I've just been buying throughout the entire time. And, in the long run, if you dollar cost average enough, you're gonna make money. So just want to show you kind of some interesting thoughts, as well as why I switched to SCHD and SCHY. I hope you enjoyed the video, and I hope you all have a great one.